You might have noticed today was a pretty wild day. We started out the day with some lackluster economic data. The data in general has been slowing. I wouldn't say we're in danger of any type of recessionary situation here, but we are seeing the data slow. We had that shooting situation in the with the House of Representatives. I think there might have been some senators there too today, and that didn't get us off to the best situation. My prayers go for Scalise and his security detail and the police that handled the situation. And then there was a Fed day. We had a Fed day, and there was a lot to discuss in this Fed situation here. And I think a lot of the weakness we've seen in the technology stocks lately were reflecting what turned out to be a more hawkish Fed. There's a lot of debate of whether the Fed was indeed hawkish or whether they were dovish, or what they were doing. And I'll say this, in full objectivity, I could probably make the case either way, that the Fed was either hawkish or neutral. I would not say that they were dovish, though. Yellen has been very dovish in the past, but today my read, I haven't read the full notes yet. I will, and if there is any difference in my analysis today, I will mention that in the weekend review with corrections. I have no problem correcting myself or people correcting me if I am incorrect, but that's a rare instance these days. I took down some notes. There was a press conference, and I'm going to go through what struck me as important. After we go through that, I'm going to go through the major market indices and talk about trade setups. And then we're going to talk about some of the stuff that I think you should be paying attention to that you might not be. And then we'll get into some of the stocks that you've either messaged me about. And wow, these are really legion today. And some of the ones that you mentioned. There's some good overlap there, so that'll work out. I'm going to try and keep this a little bit shorter. Good luck, right? It usually winds up being an hour, but let's try and do it less. All right, so first and foremost, the Fed did hike interest rates. Their target rate is now 1 to 1.25. That was no surprise. I had mentioned in the weekend review video that the probability of a hike was about 96%. So if the Fed didn't hike today, I think we would have been surprised. Neil Kashkari dissented. He's been a dissenter on the hikes lately. He's been more dovish. Smart gentleman, I've heard him interviewed. They talked about that they're going to start unwinding their balance sheet this year. That immediately got my ears up, my hawkish ears up. And then they talked about doing one more interest rate hike this year. So I'm guessing that's going to be December. So they took September off the table. So that balanced us out a little bit, right? So that made it from being like super hawkish to maybe more mildly hawkish. Because they were talking tough about maybe doing September and December, and it seems as though that September now is likely off the table. Either they'll go in September and then December's off the table, or more likely they'll wait and go in December. That's my read. 12 out of the 16 members thought that, and then they also, the same amount, thought that they'd be doing about 3 hikes next year. Then they got into the balance sheet discussion, and this is where things started turning, in my view. They said they're going to hold no more securities than necessary. Not the amount that they had in the crisis, but not the amount that they had in the pre-financial crisis. So they're walking that line a little bit. So I guess they're going to keep the balance sheet elevated, but not as elevated as it's been. They talked about solid jobs and a bullish outlook on the jobs market, which I really don't understand, because there's no wage growth. No one's been getting a raise. There's no inflation in that respect. There's no pressure in pricing for jobs. They talked about business investment being good. I think that actually is part of the Trump effect. Businesses are seeing a little bit more clarity in the form of no more regulations and deregulation. So I think that that's been a net positive. They talked about inflation remaining below zero, and they had some pretty big down revisions, but they attributed them to some one-time items like cell phone costs coming down and drug pricing coming down. They talked about when they do the balance sheet reduction, they talked about doing $50 billion per month, so that's like $600 billion a year. And they actually mentioned again the roll-off of the balance sheet would start this year. That's a little precarious in my view, and I think that they're betting on a much stronger back half of the year than they may get. I've always said I thought it's going to take about 2 solid years for Trump's policies of growth to really impact the economy at the earliest, even if they started right away. And it seems to be delayed a little bit, and they talked about that as well, that the policy might be delayed a little bit. Then into her Q&A. So now we're into the notes from the Q&A. They talked about the Q1 slowdown, but they said it's been rebounding. Household spending rebounding a bit. Again, she mentions the business investment picking up, and she attributed that to global growth. That's good. We've seen that definitely in some foreign markets. She talked about core inflation edging lower, and that's when she gave the cell phone and the prescription drug, the hat tip. But she also said that they're monitoring inflation closely, and then mentioned basically that everything she says is good until it's not. Like there's no set policy, and that they could change at any time. You know, if conditions got bad again, like maybe they would back off of the balance sheet reductions, or maybe even go back to QE. Again, ambiguity. I don't like that. Market doesn't like ambiguity. We like certainty. She talked about the inflation rate being 1.6%, edging up to 2% by 2018 and 19, blah, blah, blah. They've been saying that for years. She also, in the Q&A, gave a hat tip to the old symmetry. Remember where she said that inflation rates and growth have been so low for so long that they're willing to let it run a little bit hot with symmetry, meaning go above their projection. So she gave a little bit of a nod to that, but then why are they raising rates and talking about balance sheet runoff? It's a lot of contradictory statements in there. And she talked about GDP, their forecast for GDP being flat. So where is this extra growth they're talking about that they need to be hiking interest rates into? They talked about employment, a moderately lower path, so meaning the employment is improving, but it's improving slower. The rate of change is slowing. Again, not a good item. And then she mentioned about inflation being unchanged. This to me really was the icing on the cake today of her being hawkish. And I hated this, and this is really when you saw, this came out at, I don't know, what was this, like 2:30, when the market really took the header down, and I had mentioned it. This, if you have to pay attention. The Fed talks about having a neutral rate, a Fed funds rate. It's sort of like their end point, or where the interest rate would be that kind of doesn't, there's no contraction or growth in the economy. That's like their end target rate. And they've, in the past, said that they're going to stop raising interest rates between 3 and 3.5%. They've been a little fungible in that range. And now she's saying that that neutral rate could be changed, meaning they could make it higher. I didn't take it as it going lower. I mean, maybe, but they didn't say that. To me, it sounded like, if anything, they were going to raise it higher. So instead of the Fed stopping raising interest rates at 3.5%, now they might go higher. She said it wouldn't be much higher, but it's still higher. So they moved the goalposts. I mean, imagine you're a field kicker. You're on the field, your goal is to kick a field goal, and they take the goalpost and they move it back. It's harder to kick the ball, and there's more distance to go, so they could now theoretically raise interest rates even more. Very hawkish item. Did not like that. So that's something we need more clarity on. Where is that neutral rate? Where is it going to be? She's mentioned that it could be that the rate. It's funny because she talks about the rate being lower, but then the end rate being higher. it's really not good. Balance sheet this year, let's see, gradual. They talked about the balance sheet runoff is going to be gradual and predictable, and the reinvestment caps. Then they mentioned 30 billion in treasuries and 20 billion in agencies. So I guess that's the 50 billion that I had mentioned before. I wasn't sure if they were talking about 50 billion initially in treasuries, but now it's 30 billion treasuries and 20 billion in agencies. And then they are leaving room for adjustment and to alter course. So I guess that those numbers are starting points. I've thought that the Fed was going to say our baseline is like this 50 billion, and then if things are better, we could increase it, or if it's worse, we could do less or not at all. They didn't also mention, and this really, I think, there was a lot of confusion for me as well. Are they going to raise interest rates and do balance sheet runoff concurrently? Meaning, is it going to be at the same time? Will, like, for example, every quarter, are we going to get, I guess, for lack of a better word, taper of what I call QE light? A lot of people don't know that, but the Fed is basically still doing QE. They're just not adding new, they're just reinvesting it. They're kind of keeping the pool full, so to speak. So that's coming off, and the amount that's coming off is they've specified. But what I didn't understand from the Fed, again, was whether every quarter we're going to get a rate hike and the taper or whatever, the removal of stimulus, or are they going to do rate hike one quarter, increase of or decrease of the reinvestment the next, and then rate. I mean, they need to specify this. This is a big deal here. And they are not, they're kind of, what I think they're doing is they decided today to kitchen sink the rhetoric, and now they want to see the feedback, where they can and can't go. So I think this was sort of like their opening offer. But I do believe the Fed does want to be more hawkish here than they have in the past. Now we're delving into my own personal beliefs. I cannot back this up with anything other than the facts I'm about to give you. Janet Yellen is a Democrat. Lael Brainerd was supposed to be Hillary Clinton's Treasury Secretary, and they don't like Donald Trump. I have for a while thought that the Fed is political, and it wouldn't surprise me to see them be more hawkish to give him the business, so to speak. My own personal belief there. So I'll just say that. It doesn't surprise me that they're being a little bit tougher here than they were in the past. Granted, he has more pro-growth policy, but I do believe that is a factor. That's sort of the X factor, if you will. I heard an interesting question. I don't know which gentleman mentioned it, but he said that he thought the Fed was reacting to things as if things were normal, like the old days. Is the Fed still playing with the old playbook? And that to me was a great question, because I do still believe that the Fed doesn't realize the world has sort of changed, and that they still are playing by old rules. Like, they're expecting a certain baseline for inflation, a certain baseline for growth. They still think it's like the 90s or like the early 2000s, and they're not in a post-apocalyptic world, right? Cue Kevin Costner. But they aren't sort of updating their ability to be dynamic like maybe they should, that there's sort of a new normal. It's never going back to that way it used to be. And I do believe that it's not going back, not anytime soon. I do think we're in a new paradigm shift here with advanced automation, artificial intelligence, and some of the things that are present in the current marketplace, like Amazon, for example, taking away from retail. I mean, those stores are never coming back. I mean, it's sort of, you're in a game of attrition here. It's all shifting online. That's more automation, more efficiency, less employment ability. So that to me is something interesting. Oh boy, got to block somebody. Let's just get that done quickly. Why can't we? There we go. All right. I do expect, I don't mind some people being a little bit, I don't know, disagreeing, but we do have a certain level of decorum we expect here. So that's my notes on the Fed for the most part here. I think I covered it decently. So what I would do if I were the Fed is this. What they should do in the coming months, I think, is quantify how they're going to do this. Are we getting rate hikes at the same time with the taper or whatever? Are we going to do it every other month? Which is, I honestly think that they should do a taper without a rate hike to see what the reaction is in the market on its own, just to see how things go. And then maybe they can do combinations of it, but they need to be very clear about that. And I didn't think that today, I think today may have raised more questions than it answered. And I think that that was done purposefully because they want to see how the market reacts. Yellen even mentioned the stock market as one of their catalysts for raising interest rates. So what is the Fed really doing? They're saying that it's not a crisis situation right now. Growth is kind of crappy, but we're not in a panic, and they want to try to raise rates while they can. I think they made a huge mistake in 2013 by not hiking, and I think that they don't want to make that same mistake again. So that's really what this is about. But the today's statement, in my view, was a little hawkish. Now, there's one thing, an outlier, that kind of flies in the face of that, and we're going to have to see how that plays in coming days. And bear with me here. I know what the criticisms are about to be, but you had a breakout in TLT today. You actually did get a close above the downtrend line today, which is the first time in, a really long time. And there's still a gap fill up in the 129s, 130. So how could the Fed today have been hawkish if yields came down? So my question is this, and I wrestle with this sometimes. This could be signaling slower economic growth. I've said this in the past, that this is the argument that you're going to say, oh, Justin, you can't have it both ways, and I sort of give the answer like Paul Newman in The Color of Money. I'm his father. I tell him to play. I tell him not to play. So maybe the rates are going down because the market is sniffing out the Fed causing some type of problems, and that's why interest rates are going lower. Either that, or the market is calling bullshit here on the Fed and saying, you might be talking tough, Miss Yellen, but you are not tapering anything anytime soon, and that's a 2018 issue. Again, more questions than answered. The Fed needs some clarity. The start of the gap is 127.37, and the full gap fill is 130.09. There was a question I got today. Do I use the Fed day range to go against stock specific? The answer is you can, but I don't like it so much for stock specific play. I like it for three things: the dollar, bonds, and the stock market. I use today's range for more macro factors because the Fed is a macro factor. It's sort of like an earnings report, a quarterly for the overall market, not stock specific. Stocks will often be impacted by the Fed, particularly like what you saw in the momentum names today with very big reversals in the tech stocks, because they like low interest rates. They trade with bonds. Odd, though, that like I said, that the TLT remained high. We need to see how that plays in the coming days. I guess you could use today's range as your gauge: above long, playing for a move into the gap, or below short for a move back down to the 200 MA. The dollar, I've mentioned also, is getting, it's just been destroyed. A lot of this, though, and I will say this, is it should never have really been as high to begin with. A lot of the dollar strength was fear about the euro and the potential for Frexit and all that good stuff that had the market really scared. So the dollar, in my view, Today, you didn't quite get a full reversal. It stopped on the 200 MA, but it got very close. It bounced off the 61.8, and the reference low was 95.8, 88.5. So we're got really close. Today's range in the dollar is going to be key. If you can get above that 20 MA and sort of like this downtrend line, there could be a fairly decent move up to like the 50 for like a 50 MA test. So that's what I'm keeping an eye on for with the dollar. Today's day range as well, very key. Wait, where's my? Here it is. So there's a big misnomer that people think that the, and I shouldn't say it's a misnomer. It is real. The Fed's position on interest rates. So today you had I would say a successful check back to the breakout, which was 24.09. Today's low was 24.13. And I guess you could use today's range as a gauge now, long above or maybe short below for a rollback to like the 100, maybe even the 50 MA. But obviously higher interest rates are good for these banks. I think that the real run in the banks, though, that the rates are the gravy. The real deal for them is the potential for deregulation. So keep an eye on that. The XLFs, today's range is a good gauge. Goldman Sachs is right up against, had a downtrend break. So now could probably, if today's above, you have a 2-day high that's roughly equal, and today's low is the 50 MA. So again, for this one, I like a long above the 2-day high or short below the low for, so we're either going to play for first stop 100 MA check or the top of the range, which is 234.63. At that point, we'll revisit. Or the rollback to me would be down to like 215. So if you lost today's low, for sure, I would think that would be almost immediate. So that is my take on like Goldman Sachs. But I do like that you have 2-day ranges, bodies of ranges that are roughly equal. So there will be a play there, in my view, above the high or below the low. Bank America. Today's low was the 50 MA. Again, I like, this didn't quite break range though. This has a little bit more to go. The range high in that one is like 24.35. But the more time we spend up here, the less likely that head and shoulders pattern is. So if you're long Bank America, today's low of day is a good stop. And then JPM, let's take a look at that bad boy. Similar to Bank America, we did close 3 days now above the downtrend line. I'd like to see this really clear the 88.17. I had drawn, there were tweezers here at 89.13, basically. 89.05, 89.13. If that can clear, I think we've got, a real horse race. I'd like to see it consolidate a little bit near there and then go, because we did have a look below range. It wouldn't surprise me if we came all the way up now without some type of a break to see this thing have a hard time, like it would could flit up and then come fall back down. Today's low is a good reference because it was the 50 MA, and that's where the resistance had been in the in JPM. So we're kind of caught between the 100 and the 50 here. I like it row against that 50 MA, or if you lose the 50, I think you could probably say that we're going to come back down to at least the midpoint in the channel. So I'd be then at least looking for the 20 MA. So that is that with regard to that. So we did Goldman, we did this. Let's talk a little bit about the metals here, because that's relevant with rate hikes as well. Gold got the test. It had a double top here, a look above and fail. And then today was a really large range bar, and we closed just below the 50. Are we going to rotate all the way back down to range? That's uncertain, but I could see this retesting the 200 MA. I would think that looks like it's in the cards. Anything below 120.40 to me is a little bit iffy. And I would really need to see us again over today's high of day to feel comfortable long gold again. But I do think that there could be a rollback to like that 100, 200 MA confluence. And at that point, I'd probably be looking to play right or right out long and maybe, just maybe, selling some same week or next week out of the money puts for a long proxy. If you draw in a trend line from the 126 low, there is a higher low pattern coming in. I'd be totally down with buying that, particularly somewhere around like, if there's a bigger flush down to like 116, that's the backside of the old downtrend and the confluence with the new uptrend. So that area to me would be interesting. But my first target here, assuming we remain below 120.40, would be to that 200, 100 MA confluence. So I am thinking that there could be a little bit of potential weakness in the metals because GLD isn't a risk arbiter, it's an inflation arbiter, and the Fed just told us we don't have any inflation. So that's that with regard to the inflation gauge. I'm just going through some of these. There was some confluence in what you guys and gals wanted to talk about. All right, let's just go through some of these names here and tick them off one at a time. So advanced micro devices, not one I cover very often. I think in general the SOX is a little bit toppy here. I'm just looking at SOX quickly. You got a big up candle and a big reversal bar. That was the 6-9 day, and we're still trapped inside of that bar. I'll say this, you have a potential secure low in. However, I don't necessarily think that will be the case. It wouldn't surprise me to see this come down, SOX down to 1032 half-ish. That's the 61.8. Today's low, if you lose today's low, you would basically, in my view, negate the setup for the secure low because that's the low bookended by two higher lows. And we're below the 10 MA. So I would feel better about all of these if we could get back up above the 10 MA. And maybe I'd play for row bounces down closer to the channel low and the 61.8, with room, of course, for a little bit of an overshoot. So back to the AMD, this is now looking a little rollover-ish, quite frankly. There's a downtrend that you can draw in, a quite prominent one. This may have even had, believe it or not, a mini head and shoulders top. So I don't really I've never been a big fan of AMD. I always thought they kind of made crappy products. They're like the wannabe. They were like what you'd buy when you couldn't like afford Intel. I mean, all these chips at this point are kind of advanced, and honestly, the difference between them, it's just it's a commoditized situation, and I don't really see them doing much in terms of doing very much in terms of their progress in like mobile and AI. That's really where the action is, and I'm personally more of a NVIDIA guy on pullbacks, although we'll talk about NVIDIA right after this. So you're below the 50 MA now, and below the 100 MA. The pattern looks a little rollover-ish. I mean, this looks like looks like a head and shoulders with a head and shoulders. So I, at the very least, would need to see this thing start making some strides to get back up above that downtrend line. You know what? Let me circle that one. I think I would be better off showing you that in the weekend video because it is a quite technical pattern. It's the aforementioned NVIDIA holding up decently. Wait, here we go. Held the 20 MA the other day. We're still confined inside of that day's bar. The 142.75 being the low there, and you had to look below and fail at the 20 MA. So I guess this is still like okay as long as the 20 MA holds. If you start getting below there, I think at some point, I don't know when, there's going to be a pullback to the breakout, which is like 120.92. I like playing put ratios, meaning buying something and then selling 2 times out of the money around there. That's also roughly the 50 MA. The 100 MA is coming up close behind there. the gap fill is close to the trend. I don't think we're going to quite get that low, at least on this leg, but we do have the potential of a lower high here. So you have to be careful if you start losing like 142.75, basically 142. You need to hold 142s in NVIDIA. Below there, to me, starts becoming a little problematic. Alibaba is looking okay. I'll say this: you had the gap up the other day at 6.8, and you've spent a few days up here. Every day, basically, has been holding the range, but has been selling. You need to hold that. I mean, Baba gapped up above the channel. If it were to just check back to the channel, that's like 130s. It wouldn't surprise me to see that happen. So I'll say this: I usually am. I think everyone thinks that this thing is going to just fill the gap. I don't think it's going to do it so quickly, and I want to see how it holds 130. That to me would be a good day trade point. It's roughly a little bit below the 10 MA. And you have a 20 MA creeping up quickly. What I would love to see is if this spent a little bit more time or came down slowly, and then the 20 MA to me would be the right or right out long point for like a bounce to maybe a lower high, but it seems to be holding up. I think this thing is going to chop up high for a while, with the downside risk probably being the max to the gap fill. So that's the BABA. Tesla. This is still holding up pretty high and tight. I mean, you technically have a dragonfly doji. I guess it's just a doji. It's not a full dragonfly, but you technically have a bit of a doji at the top of the range. My max, like I talked about 360.49 being an end target with the upside gravy to 396.94. So there could be some more movement in this. I have a feeling Tesla also is just going to chop and stay high for a while. That's like a story of, everyone gets so caught up in Tesla being overpriced. It's really the story of a very heavily shorted stock with poor distribution, meaning it's not like in a lot of funds, and high consolidated owner interest with Elon Musk and his family. And that's why you get these, these big rallies in Tesla. It's also a bit of a cult stock. People sort of believe in the man. Let's go back to the other side here. What was the other one I wanted to? Oh, Amazon. Let's talk about Amazon quickly. You had that flash crash in Amazon the other day. You've now had the pullback. All the pullbacks have been higher lows. We talked about a long entry at the 50 MA and playing for the move to the 20 MA, which was yesterday. I had said that trade was sort of over. I'll keep this very simple for you guys and gals. 965 was the 427 after hours gap high. Between 962 and 965 really needs to hold, or we could have a retest of the potentially of the lows. The earnings gap low after hours was 910. So if you kind of start losing that area, that could come back into play, believe it or not. So I really need to see how this trades. You have two equal lows from the last 2 days, and it's roughly around, let's see, the low was 966, 966. So yeah, this area needs to hold. I was watching Amazon today as a bit of a tell, because it's the poster boy for the momentum stocks. I think that this is going to be range bound for a while, with correction being possible here. Again, there's nothing to be really concerned about as long as this holds like 965s to 962s. Below there gets a little iffy for another 50 MA test and potentially a secondary trend test, which isn't all that much lower than the recent low. That day we had the kind of the flash crash low. The low was 927. So I always believe algos see those things and they tend to want to retest them. So I'm a little iffy on Amazon. But again, as long as we're above those levels, there's not really that urgency there just yet. We'll see how that plays out in the next coming days. I'm in a little wait and see mode with Amazon. Longer term, I'm bullish, but short term, there could be some choppy weather. Makes sense too. I mean, you basically got the move to 1,000. It's up a lot. It could use a breather. This FireEye is just chopping around, holding up okay. Just looking here what the major, yeah, the 200 MA was very big resistance. It should now be support. It's moved up a lot. I'm just looking at the Fibonacci levels here and also a trend line. The trend line, if it were to dump tomorrow, would be around like the gap low. So, oops, hold on one sec. I think we have a problem here with the, I'll be right back. Just stick with me 1 minute. Okay. Sorry about that. I'm having, for some reason, my I have my charger in, but my battery on my phone is dying. So if you lose me, we're done for the day. We'll just keep going until the battery conks out here, I guess. So that's the scoop with regard to FireEye. That I think that there could be some pullback. Somewhere between like the 50 and the 200 MA, I would be a interested buyer, or up over the recent highs if it can consolidate for a little bit longer. Pier 1, I said I was a buyer. I'd be a buyer at $5 for a move back to 6, and that's pretty close to the case. There, 50 and 200 MA are probably going to be resistance. That's at 619 at the moment. Teva, I was a put seller. It's moving up nicely. You need to really see this thing clear. I'd say the support now is probably the 20 MA, and we're right at like kind of the 50 MA resistance. So it's probably a good idea to maybe book some profits. If you want, you could use below 30.23 as a stop. I think that would be all right, and then maybe look to get in maybe back a buck lower. I like it via short put sales. Lululemon. This is just a really choppy pattern down here. Gapped up on earnings, came down. As long as it holds the 50 MA, it's okay. Below there, to me, gets a little iffy. Camping World, we talked about selling some puts in. We're getting long at the 61.8. It's bouncing. We're close to the downtrend line here around 30. So I would say somewhere between the downtrend line between 30 and maybe 31, which is the 100 MA, is the place to bail. And I would say that you could use yesterday's low, 28.62, as a stop if you're in there. We're right around that 50 MA here. It really needs to hold the 50. As long as it holds it, it's okay. But I think that the upside here might be a little bit limited short term. So we got through these. Let's do the major market indices, because this thing is probably going to conk out in a minute. I'll try and get to some of the other ones in the weekend video. So SPY, you had a fairly narrow range today. Today was a bit of an outside day from yesterday, but the range was so narrow. We filled the gap from the Monday. There's no gap. So I'll keep it simple. We have a Fed day range now, and long above, short below. Let's just keep it that simple. Where would the short be to? I think the 20 MA, and that would be a retest of the 6-9 day range. I really like that 6-9 day range as a gauge. Long above would be to 249s. Short below would be at least to 240.32 area, which is really the breakout. So that's sort of the range I see. We're still sitting above the channel. So again, immediately, I would like long above the high, short below the low, and I'd add to it on a break of the 6-9 low. So that would be the play in short or long. Those are the two setups I see. IWM, very similar. You have a, today was a look below and fail back into range. This needs to hold 140.70 in my view. Below there to me would be a little bit iffy. We didn't quite get the 10 MA touch though, but this to me looks like it may chop around for a little bit, but again, today's range is a good gauge. Long above or short below. And the Qs are looking actually a little bit weaker, right? You got the bounce. We're still below the 20 MA. Today was a bit of a look above and fail on the 20 MA. So I guess you could use a long above today's high for a move to a retest of the 10 MA, or a short below the low probably for a retest of the 50 MA. If that were to fail, I mean, the max downside I'm looking for right now in Qs would be to like 132.71. No, I'm sorry, 132.56 to 133.48. That area, that's sort of the gap fill and the breakout retest. So that would be my, if we lose the 50, that's where I think we'd be going, and that's roughly also the 100 MA. So 50, as long as 50 MA holds, it's sort of all right. A loss of 50, I think we see hundo. So those are the major market indices, and I think we could probably call it quits there. We got a lot, wow, we got a lot done, right? One more, I want to end on GE, because I think I promised I would talk about that. So this one is really better to show the chart. Let's save GE for the weekend review, because I do have an idea of where I think this thing will be a buy, but I don't want to, it's not going to make sense unless you see it, because it has to deal with back tests of all kinds of lines. Anyway, that's my midweek video. Fed day range, very key, and all the other levels we mentioned. Have a great rest of your week. I'll see you in the Sunday video. That may or may not come out Saturday, but it will definitely be out by Sunday. If you like this video, please retweet it on Twitter. That is the all I ask. You get to watch it for free. Please retweet on Twitter. Have a great rest of your week, and cheers.